Today, a disturbing fact. A new survey shows the U.S. lagging behind in financial literacy. The Standard & Poor's Global Financial Literacy Survey shows the U.S. coming in at 14th out of 143 nations. The survey also finds only 1 in 3 adults worldwide can correctly answer 3 of 4 basic questions concerning interest rates, compound growth, inflation, and risk diversification. Certified financial planner Gary Abely is here to hopefully make you a little bit smarter about finances. So I have to tell you, when you hear these terms, I would imagine there might be some people out there that hear the terms and go, well, I'm not so sure that I would know a lot about those. But you said the questions were very basic questions.
Questions were very basic. For example, one of the questions was, is it riskier to have a portfolio of 1 stock or diversified portfolio of 10 stocks? And so about half the people didn't answer that question correctly.
Yeah, don't put your eggs in one basket. I mean, that's a very basic old maxim. Right. So let's do a little crash course, all right? In basic terms, what are interest rates? Because this is one of the parts of this.
Well, interest rates are simply the cost of money. So as you earn money, you earn interest, or you earn some type of return on your investment. Or if you have debt, you pay that interest. And so we like to teach younger people the rule of 72s, which is 72 divided by an interest rate or a growth rate equals the number of years your money will take to double.
Okay.
Conversely, you could say, all right, if inflation is running at, say, 4%, take 72 divided by 4, and you'll come up with the number of years it will take that you'll need double the amount of money. You know, we go back to when Disney opened. I think it was $3.50 for a ticket.
Right.
You know, today it's about $100.
Yeah, a little bit different.
But just 21 years ago, it was about $35 a ticket. So that's inflation. That's the growth rate. And so we need our money to grow more so that we can pay for these tickets, because who knows what they'll be.
Yeah, not just keep up, but to stay a little bit ahead of it.
You got to stay ahead if you want to increase your purchasing power. Exactly.
So what is compound growth? Explain that.
Well, compound growth is typically compared to simple interest. So take a bank account and say you have $1,000 in the bank account and you earn 2%. So 2% simple interest would be 2%. Right, so $1,020 at the end. Compound growth is as you leave your money in there, not only are you earning money on the $1,000 that you put in, but also on that $20 that you earned in interest. Yeah. So then the interest is compounding on top of the growth rate.
All right, you explained inflation. I want to go back to risk diversification. We touched on it a little bit. Why is it so important to have a broad array of stocks?
Well, we can think of Bernie Madoff, we can think of Enron, we can think of WorldCom, and you need to have diversification so that, as you said, you don't have all of your eggs in one basket. And, you know, what we see here locally is we have some employers that match the 401k money with company stock. And so if you work for a company, let's just say a Coca-Cola, for example, that might do that, and you work there for 35 years, you might have so much of your nest egg, your basket of money, tied up in just one company stock. And if anything happened to that one company,
you're sunk.
You're really at risk.
You're sunk with it. All right, where can people find you?
They can find us at financialgroup.com, and I would mention that we have financial workshops that teach financial basics. Next one is January 9th. They're free. We welcome anybody who wants to learn the basics to show up at our office.
All right, Gary, it sounds like there's some people that need to learn it, so thank you very much. We really appreciate you being